G'day, Glenn here from Precision Wealth Management. Just want to do a quick video today on some basic investing principles for when you've got a mortgage. Now the first thing I want to preface is to say that this is for if investing is right for you. If you've newly got a mortgage, you've got a lot of debt, cash flow is very tight, well then at this stage in your life, investing's not right for you. But down the track, people might have a lot of equity, good cash flow, good surplus cash flow, but they still have a mortgage and they ask questions about what to do with investing. Now, the first thing I always say to people when it comes to investing is, whilst you might think, I've got some surplus cash, I've got some surplus cash flow, can I invest that? What should I do with that? Could it be a deposit for an investment property, or could I invest that into managed funds or shares? What the basic principle I like to tell people is that it doesn't make sense for you to invest your cash into an investment when you have a non-deductible home loan. Now I'll give a really basic example here. Let's say, for example, you've got $100,000 left on your mortgage and you receive, let's say, an inheritance of $100,000. And you say, I'd like to invest that $100,000. I'd like to get a portfolio of managed funds or shares for $100,000. And you could direct that directly into an investment and have a $100,000 investment like that, and you've still got your mortgage of $100,000 there. Keeping in mind that your mortgage is a non-tax deductible debt. The way I explain this is to say, well, instead of doing that, what you should actually do is use that $100,000 and pay off your non-deductible debt. So that's gone. And then if you go re-borrow and get an investment loan of $100,000 and invest that, you end up in the exact same position. You've got your $100,000 investment, you've still got $100,000 of debt, but you've converted it from a non-tax deductible home loan to a tax deductible investment loan. And that principle is true for every dollar that's yours. So if you've got, for example, a surplus cash flow of $1,000 a month and you think, I'd like to invest that $1,000 a month elsewhere, not pay off my home loan, what I would say is that's not the most tax effective way for you to invest. You're much better off to direct that $1,000 to your non-deductible home loan every month and go get another investment loan and draw down from that investment loan $1,000 a month, because it gives you the exact same result in terms of assets and debt, but you're paying down the non-deductible debt while increasing your tax deductible debt. It's just a more tax effective way to invest your cash. The other thing that says, when you're investing in a situation like this, what sort of investment could it be? Well, it can be a deposit for a investment property, or it could be a share portfolio. But what it shouldn't be is any sort of defensive asset class. You're not going to borrow money and invest in a term deposit, and you're not going to borrow money and invest in fixed interest and bonds. So some people look at investing in ETFs or managed funds, and they might pick one that's a diversified portfolio that might have 70% growth assets, 30% defensive assets. That's not a good thing to be doing, because you're borrowing money and investing it in fixed interest investment, and it's really not achieving anything, potentially just losing you money. So when it comes to investing, if you don't want to take on all the risk of an entire share portfolio, what we say is, well, just borrow less. Because if you were going to borrow, if you were going to invest $1,000 into a portfolio that's 70% growth assets, 30% defensive assets, well, that's the exact same thing as just investing $700 into a 100% growth asset portfolio and the other $300 going to the home loan. So treat your home loan as the defensive part of your portfolio and invest using borrowed funds and invest in a 100% growth asset portfolio, only up to an amount that's appropriate for you, your tolerance to risk, and all that sort of stuff. If you'd like to know more, please leave comments or send us an email. I'd love to help.